What's up, everybody? Hope you guys are all having an amazing night. We are going to go ahead and get rolling. Let me go ahead and pause
Yeah,
our
I guessed it
session.
was you because of the
Pause my
music.
pause my music here.
It's all good.
What you expected somebody better looking than me with a lot of hair?
Hey, wait. I'm not far. I'm not far behind on that one. Come on, man.
Well, Corey's the good looking one with all the hair. I'm certainly not that guy. You have a golden set of golden locks up there. Maybe not golden, but you got locks at the very least. So
Well, it's I don't know. My dad lost his hair very late. I don't know.
nice. All
Got
right.
lucky.
Well, it is our it's our Thursday evening kind of stocks on the rock session. A couple of you in here that I don't see all the time, so I want to welcome you in. I know a number of you are probably watching the recording of this on YouTube. And our session is really designed to be kind of an open forum Q&A session to kind of talk about what's going on, what's happening in the markets overall, and allow you to ask any questions that you want. One of the things I think that is most valuable for our Traders Army members is the ability to ask whatever questions they want and talk about whatever they want to talk about, and so that we can do our best to kind of help you and get you where you want to be from a trading and investing perspective. So I'm going to change my layout here. Let's see if that works. There we go. What do you guys think? I'm trying a new layout. You like it? Does this work? All right. So I figured I would start by just kind of talking about big picture market perspective, what's going on. I mean, a whole lot of news this week. And what's interesting about the tariff threat for Greenland was interesting. And I was in the session on Tuesday morning in our strategic trader room Tuesday morning. And when we looked at the markets Tuesday morning, this is what they looked like. And so when we were looking at the markets Tuesday morning, we said, here is going to be our supply level, where if the market comes up to here, we're going to look to get short. And so I'm not sure if any of y'all jumped in on that, but the market rallied up. It hit our supply level like the kiss. And then after hitting that supply level, it moved straight down to our demand level. Just barely missed it in the afternoon, but came back and touched it the next morning, and then rallied back up into the supply level again, fell away a second time, and then, not surprisingly, the third time we blew right through it. And so I want to start with this as a good example of kind of how our levels work. And this is kind of a bit of a lesson session for you that have never used the lesson. But the way I want to think about it is this here was created due to the imbalance of supply and demand. How many of you guys were in that room Tuesday morning with me? Carl, I know you were in that room with me. Ian, you were in that room with me Tuesday morning. A couple of you guys were in the room with me. And when we looked at it on Tuesday morning, that was the level that we selected. Now, for those of you guys that are not regularly attending our sessions, you might say, well, Chuck, what in the world made you pick this, right? And why was that the level that you picked? And the reason I picked that level is because we know for sure that there were no more willing buyers at this price point. But then we got a drop, a one candle base, and another drop. That one candle base was enough for me to realize that there was an unfilled amount of order flow that existed there. And so when price returned back into that level, it was the right time for us to enter that as a short position. Now, in that case, our stop loss was still this red line up above here, and price moved out of that level very, very well. Eventually, all I look for is a 2-to-1 profit target. So I got the 2-to-1 profit target within like 3 candlesticks. It was a nice little setup. And then price came into the demand level. Now, where did that demand level come from? We had to go all the way back on that demand level. We go all the way back to here. And if I zoom into this, it looks very similar, right? It's a little bit of a rally, base, rally above that pivot low. And that little rally, base rally that exists right here, I very easily could have said, let's take this But this up here is not as clean. We chose this area down here because by using this area here, we knew that it had already been touched once, but it was kind of like a hot stove, right? The hotter the stove, the faster you move your hand away from it. And price had come into that level and then moved away very quickly. Well, it didn't stay in there long enough to really deplete the amount of unfilled orders that existed. So the next time we came down into that level, boom, we got a straight up move out of the zone. Now, the level was created way back when, and it was at the same time the news hit. Is it coincidental that the news hit at the same time? Probably, but we got a really nice move out of that level after there. And then price moved into here. Now, notice the second time we came into the level, and I want to stress this, the first time we came into the level, we traded this deep into the zone. The second time we came into the zone, we traded all the way to the top of the zone. So by trading all the way to the top of the zone, what does it mean that we did to the amount of orders that created the zone in the first place, right? What does it mean that we did to the amount of orders that created the zone in the first place? It just means that we got rid of them all, right? It means that we used up that entire inventory of orders. And by using up that entire inventory of orders, the next time we came in, obviously price blew right through it because there were no more sell orders left because we used them all up. This is a really good picture of supply and demand in a real-time environment. Okay? So I wanted to kind of stress that one for you. I thought that was a good one to kind of review today, just on how our levels work and what makes them effective. So, all right. First question I have in the chat box, and by the way, I want you to ask questions and type them in the chat box. And if you want to unmute your mic, let me know, and I can unmute your mic, and you can feel free to ask questions. Bennett says, we are moving into a new earnings period. How long do you expect to hold new trades that have just reported earnings? Awesome question, Bennett. So let's go to something that just reported earnings like Netflix. So Netflix just reported earnings, and Netflix on their earnings report gapped down, traded up a little bit, and is red today. I'd have no problem holding that trade in Netflix until its next quality demand level. So if I were to find the next quality demand level in Netflix, I got to look down and to the left to the origin of the strong rally and extend this to the left. I got to look down here. I would hold Netflix. If you told me right now that you wanted to be short Netflix, I'd have no problem with you being short, holding it down to that level at 76. Now, I'm not saying how long that's going to take to get to 76. It might take a day, it might take a week, it might take a month. I don't know how long it's going to take. So how long I expect to hold those trades is not as relevant as the price target and objective for where I think that trade could go. And so as we look at some of the earnings that we have coming up next week and in the coming weeks, right? So we have Apple announcing earnings on, let me get rid of this. We have Apple announcing earnings on the 29th after the market closes. Now, Apple has dropped into a demand level, but it's really traded to the very bottom of that demand level. So let's just say theoretically that on earnings, Apple makes a little bit of a move and goes up. Well, if Apple gaps up on earnings to here, I'll short that pig. I'd love to short Apple if it rallies back up into here on earnings, and I'll hold it until we make it down to about 230. Apple's sitting right at a cliff, and I put a video out on this recently that sitting at 258, Apple was right at an important precipice. And at that, and Apple was right at what I considered to be an inflection point where we were either going to bounce off of this 258 level and start to come back up, or we were going to start to drop below that 258 and essentially fall off of a cliff. And that's kind of what we've seen. We've seen that Apple broke below that 258 level. And as the last 2 days, the market has shown some strength after we walked back the Greenland tariffs. We've not seen Apple really do much with that. And so since Apple has been unable to be bullish on the move out of here, what I would then anticipate is that if we rally back up into here, I'd be very willing to short. So back to your question, Bennett, of how long would I be willing to hold the trade? It's not so much about how long I'd be willing to hold it as it is until it hits my price target and my objective. Does that answer your question, Bennett? Is that helpful? Now, earnings are going to often act as a catalyst in order to drive price into my levels of demand and supply. Yes, so great question. Will I sell before next earnings? So I kind of have a rule, Bennett, that I don't hold stocks over earnings reports. And I don't hold positions over an earnings report unless I've got an insurance policy to lock in my gains or I've got some sort of protection. I don't hold things over earnings. Because if you hold things over earnings, you're allowing an unknown gap element to come into play, right? When we look at stocks that have had major announcements, not Intel, was it Cisco that recently did it? When I have these earnings reports that overnight can go and I can get these gigantic moves one way or the other, I don't want to be beholden myself to an earnings report where I'm not sure what's going to happen. So I have a couple of simple rules when it comes to trading and investing. Number one is that I don't hold things over earnings. It just, to me, it brings an unknown element into a position. Number two, I don't do drugs. I don't do a lot of biopharmaceutical stocks, right? I'll give you a good example. Last year, and I had a friend who told me he's telling me all about this Viking Therapeutics. Was it? Yeah, VKTX. He told me all about this Viking Therapeutics and all this new thing, and the stock gapped up on a drug announcement on what was going to happen. Well, it gapped up unknown, and what happens if you're short on that, right? Well, then out of the blue, recently it gapped down from 42 all the way down to 25, and so my rules are I don't hold stocks over earnings, and I don't do drugs. I don't do drug stocks that are at the whim of a clinical trial or something along those lines. And sometimes that means that I miss out on some big runs, but I care about probability over time. Primarily biomedical, Bennett. Not all drugs, right? Things like Procter and Gamble aren't normally going to give me that kind of news, right? Because, yeah, drugs are bad. Okay. PG, Procter Gamble, or not things like Abbott is another one I've seen in the past, right? That different ones like Abbott was, well, this is a great example of an earnings report and why I wouldn't trade an earnings report, right? So here's your earnings issue. Like bring that one back up. This is the both of them, drugs and earnings. Anything that I have a very hard time, unknown news announcement and what the market's going to do to those news announcements, I try not to trade around those. So awesome question. Just like your mom said, don't do drugs. Don't do drugs. So, all right. Great question. I want you guys to type in if you have any more questions as we go through today, because that's really what this session is for. This session is designed to be an open forum Q&A. And if you guys want to turn your mic on and ask a question and talk, that's even better because I don't like talking to myself. I'm not very good at it. But when it comes to earnings, I will say this, as I'm waiting for you guys to type in some things. When it comes to earnings, I want to take a look and see, well, what are our earnings coming up next week? And when I look for earnings, I always use my preferred place to look at earnings is at NASDAQ.com, right? So go to NASDAQ and go to earnings right over here. And the reason I prefer NASDAQ.com for my earnings calendars is because what NASDAQ does is it sorts my earnings based upon market cap. So I love that because I know next week on Monday, the biggest company announcing earnings is Nucor, right? $39 billion market cap. On Tuesday, it's United Healthcare Group, right? And then on Wednesday, my biggest company, Microsoft, right, with its $3 trillion market cap, Meta, Tesla, ASML. Thursday, it is Apple, Visa, MasterCard, Caterpillar, right? So you can see them sorted by market cap. I love that. Because frankly, the stocks that have lower market caps, I don't really trade anyway, and it helps me to see them. Now, you can also look up an individual company, no matter what size the market cap is, right? So if I'm looking up ADP, I can still get all my information on when their next data is and all that going to be. But I really, really like so if I go to ADP and I look at their earnings, I can see when's their next earnings announcement. It'll put it right here. So I can still get all that information, but I prefer NASDAQ, market activity, earnings. That's kind of where I like to go for my earnings reports. Oh, I'm glad, Thomasina. Glad that you like this one. This one's the one that I think is the best. Investing.com is another great website. Lots of good stuff at investing.com. I think I've written a couple articles for investing.com. They do a pretty good job over there. Their articles are usually pretty insightful, but I've always just found the Nasdaq one to be really good. So next week's big earnings reports. Next week is huge in tech. You've got United Healthcare, Microsoft, Meta, Tesla, Apple, Visa, MasterCard, Caterpillar. A lot of big earnings. Great question, Bennett. Follow up. If earnings are good, but had a drop before earnings, is that a good time to enter? Great question. So let's talk about good earnings for a minute. So good earnings doesn't mean the stock is going to go up. It's really based upon the overall demand and supply and what the market believes is a fair value for that stock. Earnings by themselves are not going to be, in a vacuum, the only thing that moves stock. On the grand scheme, big picture, companies have to have earnings eventually, right? But more what trumps earnings are supply and demand levels. Supply and demand levels trump earnings. So even if a company has earnings and they blow out a quarter, it's not going to matter as much it's not going to matter as much even if they blow out earnings, right? So like here's Abbott, and it doesn't have its raise prices promoting. So Abbott raised prices, cover rising costs, and those increases hurt demand and stymied sales. So this one gapped down, and it gapped down, right? Some of the data has already been done. The result, Abbott posted a lower than expected profit during the fourth quarter and issued an organic sales growth outlook that underwhelmed investors. More important than the earnings is this: organic sales growth outlook for the year that underwhelmed investors. What is the outlook? Outlook is more important than earnings. So if a stock goes down before earnings, and let's say they come out and they have a great earnings quarter, it doesn't necessarily mean that the stock's going to continue to go up. What it usually means is what's the outlook going forward. And if revenues on a growth outlook are poor, then that doesn't necessarily matter. So for a company, let's just use Apple as an example. Apple's been going down. Let's say that Apple comes out on Friday or next week. So let's say that over the course of the next week, Apple looks something like this, right? You get let's see, hold on a minute here. All right, so let's say over the course of next week. So it's already Thursday. So Friday, and then let's say we have Monday, and then let's just say next week we have Tuesday, and then Apple comes out with good earnings, and the stock does this, right? Apple comes out with good earnings on Tuesday. Now, back to your question earlier, the stock has, and pardon my terrible drawing with my mouse, The stock has been going down, and it had good earnings, which then drove the stock up. What action am I going to take after good earnings in this supply zone? I'm going to sell. I'm going to short the stock or trade options in order to trade that stock to the downside. Because more important than all the other pieces is going to be the demand and supply. And if I believe that there are some existing sell orders here, I'm going to have a short already set up to trade it to the downside, because if I'm wrong, I'm going to place my stop loss. If I'm totally wrong, my stop loss is going to go right here. But if I'm right, my belief is that the stock will go all the way down to here, right? So now my risk is this to make this. That's about a 3 to 1 reward to risk ratio, which means if I'm right 30 to 40% of the time, I should still be really, really good as a trader. If you're just trading the security, right? I'm not talking about trading the option. I could just trade the stock and still benefit from price going down in that situation. And the outlook, if the outlook is negative, that's even better, right? More than likely, though, if the stock has good earnings and a good outlook, even though it gaps up into that supply level, I would still short it the other way. Yeah, so I prefer my rule is I want to take a little bit of money at a 2 times reward to risk, right? So this is where we get into trade management a little bit, Bennett. So let's say, let me actually pull out my my pad so I can write, so I'm not just with my mouse. So let's say theoretically that I really like, and by the way, I'm not even saying theoretically. By the way, none of this is considered investment advice. You should consult your own financial advisor. I'm just giving you my technical opinion. But let's just say that I have a sell order in here to sell 100 shares. And so I'm going to sell 100 shares if the stock comes up into that region. Okay. So that's going to be my action to take overall. Well, if we make it up to here, I'm going to sell 100 shares here. So I'm going to short 100 shares. I'm going to have a stop loss on all 100 shares right there. So if I'm wrong, my risk is very small. Now, this distance here, I'll take 2 times that distance, which would be here. And right here, I'll buy back 50 of my shares. That is going to be at my 2 to 1 reward to risk ratio. And if price comes down and hits that level, I'm going to take some of the profit, put it in my pocket, and then I take my stop and I move it down to where I got in on my remaining 50 shares, right? So now my stop for my remaining 50 shares is here. And then if price comes down here, now I'm going to close out of my other 50 shares. And so I want to get a 2 to 1 profit objective at target 1, and then the rest of mine comes at target 2. Then does that make sense? So that is all where we get around trade management. And trade management is so important because if I have those 3 to 1, 4 to 1, 5 to 1, hell, I've had 10 to 1 trades where the thing can continue to run, and you can lock in those profits a lot further on as price moves. Now, for this particular trade with Apple, once again, not a specific advice, but for those of you guys that are regularly in the trading rooms, I love this setup. You guys know that I love this setup. This is one of my all-time favorite setups. There's a number of ways that I can trade this, but I would probably be more likely when price returns to here to do something like the 250. I'd probably, when price gets up to there, be more likely to do something like the 250 by 240 bear put spread with an eventual target down here at 240. And I'd probably look at that as like a March expiration. So if I could get the March expiration for a good price at the 250 by 240 bear put, now I'm gonna have basically a trade where I don't even need a stop loss, because that's going to be an out of the money bear put spread where I would anticipate price moving in my direction. And so I don't need a stop loss in that case because I'm willing to lose everything I put in the trade. Then I just have to have my target in place. It's a lot less management to worry about. I'm not saying that's exactly the strikes I'm going to pick, but that's the one that off the top of my head is probably going to make the most sense when we return into that level. But I'm not placing that trade until after the earnings announcement occurs. Thoughts, questions? So that's one I'm looking at around earnings. Another one that has earnings coming up next week that I'm paying a lot of attention to is Tesla. I've been in the wrong place. Come on. So Tesla's another one. Interesting that we have in Tesla is we've got earnings coming up, and I don't really have a direction in Tesla, right? And so when you don't really have a direction, when I take a look, we have a TradersArmy implied volatility range, our indicator here, which shows the implied volatility relative to where it's been the rest of the year. So when I look at my implied volatility on Tesla, what this essentially does is says in the last 1 year, if we take the highest price over the highest volatility over the last year, as well as the lowest volatility over the last year, and so the highest vol would be, let's make it a easy color to see. The highest vol would be this area up here. The lowest vol would probably be right about here. Where these zones come from is over the course of the last year, this is the top 20% of my volatility range. This is the bottom 20% of my volatility range. Well, we are at basically a super, super low volatility point right now. An unheard of low volatility point. And so our anticipation would be that volatility could theoretically go lower from here because vol is still at 50 right now. What this is telling me, as someone who's been looking at Tesla for a long time, I mean, we're at historically low levels of volatility in Tesla. The market is telling us, hey, we feel like Tesla's going to chop sideways for a while. So if that's still where we are after earnings, what I will look for in Tesla is, can I get paid for some sort of an iron condor for price to stay between 510 and like 390? That to me is going to be a pretty good potential play. Now, you might say, well, I thought you wanted iron condors when volatility was high. No, because if volatility is high and you're entering into an iron condor, you might get a ton of credit, but the market's pricing in big movement, right? I want to do this where I have expectations of minimal movement, and so this might actually make a lot of sense. I could do this before earnings if I really want to, but you're taking a lot more risk in that case. If I did that one right now, I wonder what that would pay me now, just for giggles. I'm not doing it, by the way. Just a minute. Why is this being so slow? Don't need the support panel. Thank you for asking. There we go. So if I did something like the 390, the 390 by 380 bull put And then the 510 by 520 bear call. $5.10 by $5.20 bear call. Yeah, see, right now it's not paying me anything. I'm only getting paid 20 cents for that. Now that's the February option. That's because the market says there's no way we're getting anywhere near those areas. So we're not going to reward you for that. That's way too wide. We're not going to reward you for that. After earnings, I'll see what it'll pay me, but I want to be outside of these big swings, right? I might have to wind up doing something more like, I might have to do something more like 420 by 410 on the downside, right? And then the 520 by 510 on the ups. Hold on a minute. Am I getting the? Yeah, 410, 420. Oh, selling the wrong one. Big dummy. There we go. Oh, that's much better. I had the wrong strikes in there. So let me try this again. 510 by 500. I had the wrong strikes in place. That was my problem. Thought that felt a little low. 520, 510. There we go. 390, 380. Let's try that. There we go. That's much better. So now I'm getting a two. That's a better one. So the 250 credit and this is for price to say between 510 and 390. You're getting a 250 credit on a $7.50 tie up, right? So it's going to tie up it's going to tie up $5 in your account because your 750 tie up, 250 divided by your 750 is 33.3%. Didn't need to do the math on that. That's a good rate of return for price to stay between 510 and 390, right? That's pretty good. It's pretty juicy, right? Bennett, you're fairly close. I mean, you can't trust it if you're going to get huge gaps, but the after hours right now in Tesla trading here at 449 and my after hours right now are at 451. So my options will be pretty close to that when we open up, right? Clearly I'm going to want to place that once we open and it'll be a little bit different, but they're going to be really close, Bennett, in the after hours sessions. Now, if my bid and my ask was something like 475 by 422, right? And I had a huge wide bid ask spread, then no. But I've got a fairly tight bid ask spread, and that is pretty close to our closing price, so you can trust that calculation. All right. Great questions. What else? Come on. Somebody type them in. I know there's some of you out there that got a few more questions for me. What else you got? What else you got? I normally pour myself an evening beverage, but I have to tell you, normally when I used to teach this, I would teach it with Corey, and he and I would each have our own beverage. I don't feel like I'm drinking alone, but I feel like I'd be pouring myself my own glass tonight. I can't do that. It's just
you're never alone.
I know, but I'm like, thank you for talking back. I need someone to talk to me.
I'm
All
here.
right.
It's we got to get you to come once in a while in the mornings, brother.
I know. I
But
spend
I
a
know
lot of
you've got
time.
kids and homeschool and a whole nine yards.
We homeschool the kiddos, and I spend a lot of time with them. That's for sure. So,
It would be good. It would be good.
all right, what else we got? Come on, kids. Anything? Anybody got anything for me? Let's see.
I'll
NBI.
throw it out there. What do you think of gold?
What do I think of gold? I think it's shiny.
There you go.
Let's see. So NBIS. I've not traded NBIS. Woo wee! You got $1.45 on the 82 puts. Lord have mercy. That's really good. Right down here below this demand level. Yeah, that's a sweet one. I like that text. Is that and that's for Feb 6? Damn. Good find on that one. And you have earnings on the 26th, so you can roll that a little bit. I like that. That's a good one. I'll tell you what, one I looked at today was the miners ETF, the 9250s. The 9250s earlier today were paying about $1.70, and I'm okay with that. And I love selling puts on ETFs because I don't have to worry about rolling around earnings, right? So I don't have earnings to worry about from a roll perspective. I could just roll down and out, roll down and out, roll down and out as it comes into my strike until there's a price where I know I want to own the stock. So I like that one a lot. That's a good one, Tex. I'm gonna keep that one on my list for tomorrow. Bennett, great question. I mentioned trading only large cap. What's my minimum cap? It's not so much minimum cap as it is minimum volume of shares traded per day. So when I do a screener, the stocks that I scan for, I want a minimum average volume of 800,000 shares a day and a minimum price of $15 a share. So I don't really trade anything less than $15 a share and less than 800,000 shares a day. Pretty much all of my scans, no matter which scan I set up, that's what I look for. So my overpriced, no ROE below the 50-day simple moving average still is going to be, you know, maybe a market cap of 50 million or so, and it's still going to be done in that way. That is stock trade volume, Bennett. When I do that, it's stock trade volume. So all of my scans are based upon stock trade volume. And if you don't, I'm not sure what platform you use, but one of the best screeners out there, for those of you that don't know about it, and once again, not affiliated in any way. They don't pay me anything, and so if you don't want to use them, their advanced stuff, you don't have to. But FinViz has great screeners built in. So I have a FinViz screeners that I'll use. You can use FinViz. And when I go to FinViz, the first thing I sort by FinViz, there's 10,840 stocks that are in its tradable universe. That's not my tradable universe. My tradable universe is average volume. I could do over 750 or over a million. It's not totally customizable. When in doubt, go higher. So over a million. Price over $1. Price over $15, excuse me. Over 15. So now just doing that has taken my tradable universe down to 1,578 shares. Average true range, meaning how much does it move every day? I want an average true range over $1. If the stock doesn't move, it's not worth trading. Takes me down to 1,030. And then I want to look for things that are both optionable and shortable, right? So I want to look for things that are both optionable and shortable. So my total tradable universe is 1,010 stocks, right? Now from there, I could screen it a bit more, but that's the FinViz screener. Another very good screener, if you're not familiar with it, is on TradingView. Once again, no affiliation with them. I just think they do a pretty good job. Let me log in real quick. So when I use TradingView, they've actually got a pretty good options program in TradingView as well. I will go to this screener here that I've built, right? Now in this one, I say price over 20, average volume over 800K. And in this one, I've got some fundamental indicators on here as well, ROE, things like that. But this is how I build my screeners is based upon price 15 over 15 to 20, average volume over 800K. So hopefully that's helpful for you, Bennett. All right. What other questions y'all have for me today on this glorious day? Anybody got anything else fun to talk about before I wrap us up and send us home for the night?
Hey, Chuck, um,
Yes.
um, you guys published the option strategy um, uh, uh, not work lists or whatever, right? You
Okay.
guys, do you still follow those? I don't see them
Option.
come up in the classes very much.
So I still follow those. That you mean the work, like the checklists and the worksheets, things like that?
Yeah, the worksheets. Yeah,
Yeah.
but
So still follow those. We don't pull them up as much, to be quite frank, Mark, because most people that are in the classes don't ask those kind of questions, but clearly would pull those up anytime somebody wants to use those. Because that checklist is a great checklist to kind of follow. I know we have them already in there, but it's like once you've done it so many times, it kind of you just kind of do it naturally.
yeah,
And so we do still follow those. We still do have them. We just don't go through them as slowly and as quickly. But that's something I could bring up to Corey that in the class, I'd love to bring those up and we could run those in more of in the options trading room. Sometimes what happens is when Corey and I teach these classes, we sometimes go so dang fast because we do the checklist in our head because we've done it 10,000 times. But if you think it's
yeah,
worth us slowing down and going through them, 100% we could.
yeah, and it's not so much the checklist, read the news and all that stuff, but it's more if you're doing um, a spread, then make sure you go out 45 to 90 days. And if you're doing a single leg, go out 90 days. It's all
Yep.
that kind of stuff that I found valuable.
Yeah. Yeah, we still have those. It just depends on the strategy we're using on those. Like for example, like on a bull call spread, if I'm going to use a stop loss, right? So let's say I'm doing let's use GE. So let's say I'm looking at GE and GE I'm looking at today gapped down, came into an area of demand. Let's say that today I wanted to get long GE
Yep.
because we've come down into a demand area and I'm building the bull call spread. I know that building the bull call spread on GE, if I'm going to use a stop loss, I'm going to want to have a delta of 0.25. I'm going to want to make sure that my spread or my debit is no more than 50% of my spread, right? And I'm going to want to make sure that I'm going to give myself enough time for price to hit my eventual target.
Right.
And then I want to know that I've got at least a 2-to-1 reward to risk. Well, my first target on here would be 325. Eventual target would probably be 350. And so on GE, if I was doing this position, now I'm looking at going out probably 57 days. And in order to build my 0.25 delta, I'm going to have to I go one strike in the money to do the 0.64 delta, and then to get a 25 net delta. So I know I'm going to have to do the 290 by 310. So the 290 by 310 is going to net me my my 0.25 net delta. And
Yep.
because it's a $20 spread, as long as my debit is less than 50% of the spread, then I'm being in good shape.
Yep. Yep.
Right. So I do still do that, but frankly, sometimes I do it so darn fast because it's like, hey, slow down. Why did you do that? I love it. I can bring that up to Corey that maybe when we do our options classes, we can bring those up and slow down a little bit.
Thank you.
No problem, brother. Thanks for asking. Anybody else? Anything to add? All right. Well, I'm going to log this thing out tonight. I hope you guys learned something this evening. It was worth your time. Those of you guys that are not members, come join us. Come be members of the community. Hopefully it's something that you will find value and you enjoy hopping in with us. I'm glad I got to see you today. You telling me to get a haircut? Come on, man.
Thank
This
you
is
for a good little review of everything. And come join us one morning, man.
I'll get in there. All right. Much love, guys.